Hello, and welcome to our channel Top 10s You Should Know. Before we dive in, let me ask you something. Have you ever felt that rush of excitement when thinking about investing in the stock market, only to be paralyzed by the fear of losing money? You're not alone. That's why today we're breaking down the top 10 things you must do before investing in stocks. These aren't vague cliches. They're practical, life-changing steps that will help you enter the market with confidence, clarity, and a game plan. So, grab a pen, because these are the foundations that separate successful investors from those who crash and burn. 1. Build a strong financial safety net. The first and most overlooked step is creating a solid safety net. Many people rush into investing with every penny they have, believing the stock market will quickly double or triple their money. But here's the harsh truth. Markets are volatile, and if you don't have an emergency cushion, you'll panic and sell at the worst possible time. Financial experts recommend at least 3 to 6 months worth of living expenses in a liquid savings account before buying your first stock. Think of this as your shield. It protects you from being forced to sell your investments when life throws curveballs like job loss, medical bills, or unexpected expenses. Without this safety net, you're not investing, you're gambling. And gambling with rent money? That's a disaster waiting to happen. 2. Eliminate high-interest debt. First, imagine pouring water into a bucket riddled with holes. That's what investing with high-interest debt is like. If you have credit card balances charging you 20% interest, no stock market return will consistently beat that. Let's say you invest $5,000 in stocks while owing $5,000 on a credit card at 22% APR. Even if the market gives you a 10% return, you're still bleeding money overall. Eliminating high-interest debt is like giving yourself a guaranteed return on your money. Every dollar you pay down is a dollar you no longer lose to outrageous interest. This doesn't mean you have to be 100% debt-free before investing. Mortgages or low-interest student loans are different, but those crushing credit card bills, they're financial quicksand. 3. Understand your investment goals. Before you buy a single stock, ask yourself, why am I investing? Are you saving for retirement, building wealth for your children, or trying to generate income for the next 5 years? Your goals determine everything. How much risk you can take, what stocks you buy, and how long you hold them. Someone investing for retirement in 30 years can afford to take more risks than someone saving for a house down payment in 3 years. Too many beginners skip this step and end up making random trades that don't serve their life plans. Clarity here is power. Write down your investment goals, the time horizon, and how much volatility you can stomach. Then, build your stock choices around that framework. 4. Learn the basics of stock market education. Here's a truth bomb. If you don't know what a PE ratio is or how dividends work, you have no business throwing money into individual stocks. Think of it like playing poker without knowing the rules. You might get lucky once, but eventually, you'll lose big. Before investing, spend time learning the fundamentals. Understand terms like market capitalization, earnings reports, volatility, and diversification. Get comfortable reading balance sheets and annual reports, at least at a basic level. And no, you don't need an MBA. There are endless free resources, online courses, and even YouTube breakdowns that can teach you the essentials. 5. Decide on your investment strategy. Blind investing is dangerous. You need a plan. Will you be a long-term buy-and-hold investor, building wealth steadily over decades? Or are you interested in short-term trading, trying to capture quick gains? Maybe you prefer dividend stocks for steady income or index funds for broad exposure. Each strategy requires different knowledge and discipline. Without a strategy, you'll constantly second-guess yourself, buying high, selling low, and chasing hype. Remember, the best strategy isn't the fanciest. It's the one you can stick with consistently. Legendary investors like Warren Buffett didn't get rich by timing the market every day. They had clear strategies and followed them for decades. 6. Set a budget for investing. Never invest money you can't afford to lose. That doesn't mean you will lose it, but it means the risk exists. Decide upfront how much of your monthly income can be set aside for investing without sacrificing your essentials like rent, bills, and food. Many experts suggest starting with 10 to 15% of your income, but even $100 a month consistently can build wealth over time. What matters is consistency. By setting a budget, you avoid emotional investing, like throwing in extra money during hype or panic selling because you overextended yourself. Think of investing as planting seeds. Small, regular amounts grow into something powerful over time. 7. Diversify before you begin. Here's the trap most beginners fall into: putting all their money into one or two hot stocks. It feels exciting, but it's incredibly risky. Diversification spreads your risk. If one stock tanks, your entire portfolio doesn't collapse with it. This doesn't mean you need to own hundreds of stocks. Start with a mix of sectors like tech, healthcare, energy, and consumer goods. Even better, consider index funds or ETFs that give you exposure to dozens or even hundreds of companies in one purchase. Diversification won't make you rich overnight, but it will protect you from devastating losses. It's like having multiple lifeboats on a ship instead of relying on one. 8. Choose the right brokerage account. Not all brokerages are created equal. Some charge high fees, others offer limited investment options, and some lack the tools you'll need to succeed. Before investing, compare platforms. Look at their fees, ease of use, educational tools, and whether they allow fractional shares, which are perfect for beginners. Some brokerages even offer automated investing options if you prefer a hands-off approach. Picking the right platform is like choosing the right vehicle for a road trip. You need one that won't break down halfway and that actually gets you to your destination. Don't just download the first app you see advertised. Do your homework. 9. Prepare mentally for volatility. This might be the most important step of all. The stock market will test your emotions. One day, your portfolio might be up 10%, and the next, it could drop by the same amount. If you panic and sell every time there's a dip, you'll lose. Successful investors don't avoid volatility. They learn to ride it. You need to mentally prepare yourself for the roller coaster. That means understanding that downturns are normal, crashes are opportunities, and patience is your best weapon. Think of it like turbulence on a plane. It feels scary, but the pilot knows how to handle it. And if you stay seated and calm, you'll land safely. 10. Commit to lifelong learning. The stock market is constantly evolving. New industries rise, old ones collapse, regulations change, and global events shift everything overnight. That's why the final step is making a commitment to lifelong learning. Read books, follow reputable financial news, study successful investors, and never assume you know it all. The moment you stop learning, the market humbles you. But if you stay curious, you'll always find new ways to grow and adapt. Think of learning as fuel. It keeps your investing engine running for decades. And there you have it, the top 10 things you must do before investing in stocks. Now let me ask you, which of these steps have you already mastered, and which one do you need to start working on today? Let us know in the comments below, because your journey could inspire someone else.